Hello, and welcome to the 8th Annual Rutgers Private Equity ESOP Symposium. My name is Ted Margarit. I'm a managing partner at Paralign Capital Partners. We're a merchant bank focused on serving family founder businesses of scale pursuing ownership transitions. We have two segments of our business. First, we're known nationally for our expertise in large, complex ESOP transactions. So we focus our advisory services on businesses with an enterprise value in excess of 100 million. And the other part of our business, we manage capital on behalf of a network of predominantly family offices who make investments in support of our clients' ESOP transitions. And so we very bullish on the future of employee ownership in this country. And I'll talk about some of the trends that we're seeing in the marketplace today. First, on the seller side of our business, so advising family founder business owners as they pursue ownership transitions. What we're seeing on this side of the house is that ESOPs have really gone up market in the last year. 2025 is, I think, going to go into the record books as a year in which larger businesses take ESOPs seriously and really take a hard look at ESOPs relative to more traditional forms of ownership transition, private equity sales, strategic sales, et cetera. And what we're seeing in that is not just businesses of 100 million, but really the number of businesses that are 300 or 500 or even $1 billion of value. Looking hard at ESOPs has increased dramatically throughout 2025. We're really seeing upmarket businesses take a hard look at the ESOP model, and not all of them ultimately pursue it, but at least consider it on an even playing field with other more traditional corporate finance options. Within that market, we're seeing real growth in an interesting subset of the economy, and that's asset managers. So specifically, the number of real estate developers, property managers, real estate private equity firms, proprietary trading firms, hedge funds, what I'll call the knowledge-based economy. The interest in that segment of the market has grown rapidly, and I think it's due to not just some better awareness of ESOPs broadly, and I'll come back to that point in a little bit, but it's also reflective of the situation on the ground in those businesses. Those firms tend to have distributed ownership in a partnership type model already, and they also tend to be very tax inefficient in that they don't have natural tax shields. And so by using an ESOP model, we've unlocked tremendous tax savings, and by providing equity to those that drive the business, we're seeing lots of interest in a natural alignment between those firms and the ESOP model. And we think that trend will continue throughout 2026, particularly as the interest rate environment normalizes and enhances valuation and liquidity to those firms. What we're also seeing is that as awareness of ESOPs have grown, we're seeing many more sellers self-select into the things that ESOPs really provide, which is retaining control, retaining equity upside, getting some tax benefits, and really more of a structured, gradual transition out rather than one more dramatic sale of a business, a watershed, singular watershed moment. And I think that's resonating more with sellers who are saying, I've devoted my life to this business, creating this business, building this business. I'm not ready to walk away overnight. And in the ESOP model, they remain the boss. They're not reporting to a private equity firm or outside investor. And the ESOP model lets them transition on their own terms. That's something that really is resonating of late with our client base. On the other side of the house, as we talk to capital providers and investors, the ESOP model has become much more well known. I would say that most people have never invested in an ESOP that we're talking to, but they are certainly aware of it. Many of our family offices own businesses that they've come later to tell us they wish they would have looked at an ESOP when they sold it and generated their liquid wealth. So they look at this as, it was too late for their business, but they're hoping that through their capital, they can support the growth of ESOPs in the country and at the same time generate attractive risk-adjusted returns. And so for our model, again, we invest on a pari passu basis, so pari passu with the founder of the business. but we're investing as minority equity, targeting returns north of 20%. And what we think is attractive in this model is not only do we get the benefits of full alignment with the founder of that business who built it, made it successful in the first place, but the tax enhancement of the ESOP provides a lot of downside risk mitigation. And there's been numerous studies. In fact, Rutgers did a famous one, great one, that looked at lender default rates of ESOP loans in the Great Financial Crisis relative to non-ESOP leverage loans. And what they found was that the default rate was a small fraction of the broader market. And that, we believe, is a very powerful demonstration of how ESOPs serve not just in the tax benefits, but this idea of shared ownership to enhance value to investors by reducing downside risk. And so investors are very focused on that. On the other hand, the complexity of the ESOP model is intimidating to some of those investors, and they're struggling to wrap their arms around it, particularly at a time where there's not a lot of large capital allocators who have demonstrated sort of the model. And so no one there's a risk aversion. No one wants to be the first mover at scale, which is partly why we think the family office network or family office investors is a better tool who are less sort of herd sensitive rather than some of the pension funds, et cetera. On the other hand, what we're seeing is that while our capital availability, the amount of capital we have available to deploy has grown rapidly, on the other hand, we still do struggle with sufficient targets and opportunities to deploy that pool. Sellers, as they look at an ESOP, they still see, hey, if I choose to pursue an ESOP, my liquidity is going to be less attractive relative to a private equity or strategic sale. And so many sellers, particularly sellers who have built businesses that are worth higher multiples, typically they will look at an ESOP as less attractive, and that is limiting our investment pool. And so we believe if we can bring more capital to bear in this market, it will create more interest in more what I'll call institutionally investable businesses. So right now we're stuck in a bit of a catch-22. There's some efforts in Washington to enhance capital available to the ESOP market. And we think that over 2026, we think that logjam will start breaking, particularly as more investors become aware of the ESOP model, returns are realized that are quite attractive, demonstrating the ability of the ESOP model to work in favor of investors. We think that there will be a positive feedback loop that we're starting to see happen in the market and will accelerate throughout next year. And as that happens, more high quality institutionally investable businesses will become available. So it's a very exciting time in the ESOP market, and look forward to sharing today's presentations with you as we explore that further. So hope you enjoy the rest of the symposium, and thank you for joining us.